Even in a landscape with high interest rates, a record amount of mortgage renewals taking place, a record high amount of pre-sale inventory, 12-year high in resale inventory, tightening lending practices, low consumer confidence and sentiment, even with all of those things in tow, real estate prices still haven't really crashed, at least not here in Vancouver. And we've only experienced over the last 12 months a decline of 2.8%. And sure, maybe we're 7% off of peak prices from 3 years ago, but we're also 12% higher than we were 5 years ago. All this to say is why, or maybe how? Why haven't home prices fallen further when it seems like the financial landscape and the economy are practically in ruins? Well, there are a number of very important data points that shed light on that question. And they demonstrate why Canadian real estate continues to be one of the most stable marketplaces in the world. Let's have a look. First off, a major contributing factor is the growing net worth of Canadians. It grew an additional 0.8% in Q1 of this year. Household net worth just hit $17.7 trillion in Q1 2025. And yes, that is an all new record high amount. It is also up 82% in the last decade. And furthermore, the household debt to disposable income ratio, well, it has improved from about 185% in 2022 down to 172% today, emulating the levels that date back to about 2015. We're at like a 10-year low. That's a good thing. The household debt servicing ratio has held steady at 14.4% last quarter, and that is down from the 15.1% peak that we experienced back in 2023. And lastly, this is a very important one, the asset to debt ratio in Canada is $6.68 worth of assets for every $1 in debt. That also is near an all-time high just outside of the COVID era, which of course was free money and no spending. This showcases that the majority of Canadians have the ability to pay debt and weather things like a mortgage renewal, the phase that we're essentially currently in. Now, before we get a little too optimistic here, let's remember that Canada's household debt to GDP ratio, it's still the third worst in all of the G20, and it sits a massive 40% above that G20 average. So, we've got households that have 6 times more assets than debt, and they've got this high, debt to GDP ratio. But ultimately, Canadians are finding a way to pay the debts that matter the most, that of course being mortgages.
Yeah, and let's continue to look at this because, Dan, I feel like we would have seen with how you laid out that start when you've got, the high number of listings, we've got we've got high listings, we've got unaffordability, we've got prices that really haven't dropped to a point that make a lot of sense yet. So when we look at the asset to debt ratio, it's an incredibly important part of the story that constantly gets overlooked. And it's one of the largest contributing factors as to why home prices in Vancouver have not dropped more than they have. That and the fact that over 50% of homes in Vancouver, they're completely mortgage free. Those two factors heavily contribute into this story. In fact, the next one here comes from Realtor.com. The data though it heavily reflects what we're experiencing here. When a home seller lists their property only to find out they can't get the price they want, they are, at an increasing rate, delisting their property instead of lowering the price. In May, delistings jumped a whopping 47% year over year and up 35% year to date. This is a sign that sellers would rather wait than negotiate. So, while they would like to sell, they don't have to sell. And the financial landscape outlined earlier explains how this is possible. Unlike the past cycles where falling prices pressured less asset-rich sellers into taking lower prices, today homeowners benefit from a record high level of home equity. And simply, they're just going to take their home off the market if they can't get the number that they want. I guess what we have to figure out here, Dan, is whether or not the current issue where we're seeing prices continue to come down, is that a short-term issue or is that a long-term issue? I think there's some unforeseen outcomes. We'll touch on them later, primarily being like this particular circumstance does not help the plight of younger generations trying to buy a home in Canada. And I think what's more is, when they have that nearly $7 to every $1 of debt, you're going to have to see that transfer of equity, that transfer of wealth in order for prices to maintain. Otherwise, the income to debt GDP ratios we mentioned earlier, it's still extremely high, especially for Canadians who don't have an asset.
Something else that is applying to maybe a bit of a stable marketplace is consumer insolvencies. And we've been touching on these for, years, almost since we started this podcast. And they've obviously been steadily increasing basically since the post-COVID era. But they may have peaked. And the data is starting to reflect this now, because the percentage of consumer insolvencies, it actually fell year over year in May, down 2.6%. And that's kind of showing more signs of stabilization, at least for now. While it is an improvement, do note it's still like more than 7.5% higher than the 4 years prior to the pandemic. So we have not returned back to those long-term norms. But also, business insolvencies look to be improving. They're down an impressive 13.3% year over year. This metric is also above those long-term averages I mentioned, though it is promising to see both consumer and business insolvencies trending downwards for the first time in about 4 years. It may ultimately mark the turning point, or at least demonstrate, again, a level of stability, which could set the tone for improvement over the coming years as things like interest rates stabilize, potentially go down, and the world kind of settles into what is now truly our post-pandemic world.
With that said, though, it still doesn't address the economic divide that's taking place, much to what I said earlier. While one segment of the country is doing okay and arguably even improving, there is another side to that coin. The economic divide in Canada continues to increase, demonstrated this week by a number of polarizing financial figures. The BOC's Financial Vulnerability Report noted that we now have the highest share of indebted borrowers on at least one of their credit products. In the past decade, surpassing Q2 of 2020, that was the high. This number is now at 2.6%. 2.6% of Canadians with debt are delinquent on at least one of their products. So what are those products? When people are financially stressed, the first payment that they typically skip is their retail buy now, pay later style installments, like a couch or something like that. The monthly payment on your new couch, for example, after that is credit cards. Those ones will get missed. Then the third is car loans. Then it's down to the mortgage payments. And finally, it hits your HELOCs. The share of indebted borrowers hit a cycle bottom in 2021 at 1.8%, and that has increased 45% to reach today's 2.6%. A decade high in missed debt payments is extremely concerning and demonstrates the financial stress that many Canadians are facing today. But this doesn't show the percentage of Canadians that are making payments, but have had to pull back on every other part of their livelihood just to stay solvent. That cohort is the majority of our nation. That is the middle class. The segment that largely drives the economy. And with the majority pulling back, the country is grinding slower and slower and slower, creating much bigger problems, including a much lower GDP and a GDP per capita and increased unemployment.
Something else that has a sort of double-edged sword connotation to it is rental rates. Of course, when rental rates go down, it helps serve one segment, but it also hurts another segment. And we've got an interesting rental update for you now, because national rental rates or Canadian rental rates have dropped once again and have now lowered for 9 consecutive months, down 2.7% on the year. The average rental rate in Canada right now is $2,125. This is much more pronounced in our major cities, where Toronto rental rates there are down just over 5% on the year, and Vancouver rates are actually down 6.5% since this time last year. It's also very interesting to me to find that Calgary, it actually leads the country with the largest drop at just under 10%. I mean, this is an area that is still essentially experiencing the largest amount of population growth in the country, yet rental rates are dropping. I think that speaks a bit to the exuberance that we saw just over the last year, and things are starting to pull back now. That 2.7% year over year rent decline in June, it was smaller than the 3.3 we saw last month, but despite the dip in rents during the past year, average asking rents in Canada, well, they still remain just over 4% higher than they were from just 2 years ago. And if you can believe it, they're still 12%, higher than they were just 3 years ago. Definitely running a little bit hotter than inflation. Now, when we look at rental rates by the bedroom count, or ultimately the size of them, the less bedrooms the property has to rent, the higher the rate. So studios, they ended up yielding the highest increase and the lowest decrease over the past 3 years, and was literally followed in order by 1 beds, 2 beds, and 3 beds. So you can imagine if you are a landlord, a housing provider, your studios are outperforming your 3 bedrooms by a pretty significant margin. British Columbia leads the country in rental rate, no surprise there, followed by Ontario. But third place, the third highest province rental rate, guess what it is? Nova Scotia. And that's only $60 less than Ontario on a monthly rate. And if you are looking to have the lowest rate in Canada, well, you will find that in Saskatchewan. That is, of course, where the lowest rental rates are. As I mentioned, the other side of this is, of course, landlords, right? If you are an investor or you own a condo and every single month you're seeing your expenses typically go up, but now you flip your property and the next tenants are coming in and they're 6.5%, 7% lower rate. Well, obviously the delta makes your overhead diminish more. Maybe you're now cash negative or deeper cash negative, making that asset class less attractive. And I actually did a deep dive on this on the other YouTube channel. So have a look at that if you want to know more about what's happening with rents and investment condos as a whole. Are they dead? When will they come back? All those questions are answered on that episode. Have a look.
Yeah, and then moving over here to address new supply and how the city is trying, or at least the government's trying to help with this. So with the extreme lack of new housing built due to the immense amount of pressure and challenges that are faced by developers today, the cries for the government to assist are becoming much louder. In fact, the pleas look like they're even starting to be heard, as there is a one recent improvement that's worth noting here, reporting on the development of new homes. The BC provincial government announced on July 3rd that 75% of the development fee can now be deferred until the occupancy permit, or 4 years, whichever one comes first. 25% of those fees will remain payable on the building permit. And while this doesn't help affordability really at all, the fees, they're not being reduced or anything or paid by somebody else. They're just simply being deferred. So it does help with the developer's cash flow at the start of the project, which is very important when it comes to actually financing a project and launching it. For example, in Burnaby, a multiplex building is averaging $85,000 per unit in city fees. That's $500,000 for 6 units. This includes DCCs, ACCs, Metro van fees, offsite cash in lieu. You can imagine how much it helps a developer by saving 75% of that money up front to bring 6 more homes to market. Being able to defer $375,000 worth of fees is no small feat. Then they use those funds to put towards materials and trades, and they can get going a little bit faster. And they pay the fees at occupancy, which most often means they've already recouped the fees, as these units likely would have been pre-sold. And while I would have much rather seen a 75% reduction in fees, this is at least a step in the right direction that will have a direct effect on new homes being built.
It definitely does help. I mean, it's a pretty big step. Obviously, we both feel they could have gone further, but ultimately, anything that helps a developer get shovels in the ground right now will be considered a win. And deferring fees, it definitely does do that, as Ryan illustrated. So we're taking this as a win, and it will help, and you will see more homes slowly start to come to market because of this. And I think it's also quite important to point out that this is going to be, just the beginning. We're going to hear a lot more incentives and sort of maybe some red tape shifting, maybe some new policies that will ultimately help developers bring homes to market. Because right now their back is up against the wall. They cannot bring product to market because they'll lose money if they do. But we need new homes, obviously, right? Like, our prime minister just said he's going to double the amount of homes being built. And that is the opposite of what's truly happening with actual housing starts, as we've seen in the data. So expect to see a lot more incentives helping developers coming up in the next couple of years here. Now, next up, another story about multiplex. So that obviously helps multiplex builders, and so does this. So there was a recent ruling at the Supreme Court of BC, and it shifted the outlook of how multifamily construction on lots with covenants restricting them will go moving forward. So like prior to this July 3rd ruling, properties that have titles which include a covenant restriction on them, like let's say the covenant says you can only build a single family home on this lot, that actually superseded the provincial legislation that states that multiple units can be constructed. So the judge in this case ruled that the covenant registered actually in the late 50s. There's a bunch of them apparently. There's about 200 or so that were located in the Squamish area, are now obsolete and should be canceled. The covenant prohibited the construction of anything other than single-family residences. So that is, I think, a win. And of course, it's an outdated one. We've heard of outdated covenants before. A lot can happen in 75 years as far as what we need for housing and densification and so forth. And that exactly is a specific case. And yet, in another BC Supreme Court case, a judge changed the language of a covenant registered on a set of properties in Nanaimo that had been put into effect in the 70s. He dropped a phrase that specifies dwellings will be, quote, for not more than one family, unquote, because that restriction is inherently vague and uncertain. The cases come as some homeowners, have been going to court to actually prevent the building of multi-unit housing, citing these restrictive covenants, right? It really does showcase how not everyone is very pro densification right now. And what has happened is the case was up in Squamish, and there's a homeowner who saw multiple units coming up either next door or nearby and saw the covenant on title and said, hey, you're not allowed to do this. Because obviously that individual was not pro development. He did not want his area to become more dense, or her area. And you could imagine that more local, right? Like if you had a nice large home in Shaughnessy, for example, it wouldn't be too surprising that maybe you don't want 6 smaller homes or a multi-family building going up right beside you. I get it, right? That's NIMBYism. It's a thing, and it will be for probably ever. But it's an interesting aspect to the housing crisis that we're in, right? It's other homeowners are also preventing, or at least trying to prevent, development. Right? We've got certain municipalities that are pushing back on things like the multiplex plan, i.e. West Vancouver, but we also have individual homeowners in places like Squamish that are saying, no, I don't want development on my street either. So it's not just like the city that makes it difficult, but it's all the way down to the individual homeowner now, and of course, all the red tape in between. Properties with covenants can be very tricky. Okay, covenants are not only hard to remove, but they are costly to remove, and they take a lot of time to remove. So if you are considering purchasing a property for a multiplex development, it is imperative that you review and understand any covenants on title, as again, they do currently supersede the provincial legislation, though that is obviously changing as of literally this week. And this is an area that we specialize in. We have multiple clients that are under construction today with multiplex. And so if it's something that you would like to learn more about, our contact information is below. Please reach out, and we're happy to talk about the best lots and the lots to avoid and what the covenants mean. Ryan, what's your take? Is multiplex going to get some traction here?
I think it's only a matter of time. Like we just talked about, at the start of the episode, when you consider the fact that the vast majority of younger Canadians don't have the money to pay for the single family homes or for homes generally speaking in Vancouver, there has to be a solution for them. And, otherwise the path to home ownership is going to take place when you're 56 or 60. And there's no wealth to be made at that time. You're completely out of time, generally speaking. There's no compounding that'll take place, and overall Canadian wealth will fall. or we will see a humongous economic divide. Both are not healthy for the outcome of Canada.
I agree. I agree. And yeah, we've discussed and pointed out how the median age of first-time home buyers continues to increase. It's up to something like 40 now, and it's even higher in the States. So being able to bring gentle density into cities, being able to provide more supply could very much so result in lower prices, which then might make it more accessible for younger people.
Do you know, Dan, the average age of a home buyer in the US right now is 56 years old? It's crazy. And that's due in part because of the cost to buy homes. And it also shows you who's buying and selling homes in the US. It's people who bought homes 30 years ago, who have made those lifts in equity, who are able to make those payments. Otherwise, it's just not happening because even they, without their equity, would not be able to buy the homes that we have today on the market. It's just they're too expensive.
There you have it. Okay, that is our episode for this week. Thank you as always for tuning in. What's your take? Have you offered on a property and were surprised how sticky the seller was on their price? Or did you have your eye on one and it just came off the market and you're not quite sure why, just to find out that the seller couldn't get his number and maybe we'll relist next year or something? We'd love to hear your stories as well. Please leave some comments. We do read and reply to most of them. So yeah, thanks as always and have a great weekend. Bye.